Well, with interest costs on some mortgages going up a whopping 250% since this time last year, mortgage lenders as well as mortgage insurers are having to change the way that they do things a little bit, resulting in some people paying up their mortgage instead of paying it down, and some people even stretching out the amount of time it's going to take to own their home dramatically. But some are saying that these changes could come with some major long-term consequences, and the deciding factor on whether or not these long-term consequences come to fruition is, yep, you guessed it, the decisions upcoming by the Bank of Canada, Canada's central bank. So let's talk about why the banks need to make these changes in the first place, as well as what the actual changes are, the negative consequences that could come down the line from these changes, as well as why the fate of everyone is just tied up in the decision by the Bank of Canada. So let's get right into it, and make sure to subscribe to the channel if you haven't already done so if you want to keep on getting Canadian updates just like this one. Now, last week on the channel, I talked a lot about how during the past few years, a lot of Canadians had to qualify for mortgages as if interest rates were at 5% due to something called the stress test. Even though interest rates were in the 1s and 2s, they had to qualify at the 5% mark, and now we're entering the unique situation where actual interest rates are going above where many people were stress tested, where they had to show that they could actually afford a mortgage at that rate. In other words, for people who were just barely able to qualify under this 5% stress test, well, now if they were trying to re-qualify for that mortgage, they would be deemed that they couldn't afford the house that they already own. And the way that they determine whether or not you can afford a home or not are through two very simple ratios. They're easy to understand. One's called GDSR and one's called TDSR. GDSR stands for Gross Debt Service Ratio. It sounds complex, but it really isn't. This essentially is just comparing how much it's going to cost for you to own this home versus what your income is. This includes things like your housing insurance, your utility costs, things like that, as well as the mortgage payment itself. Now, in order to qualify for a mortgage, most places say that you need to have have your housing costs be under 39% of your total income. TDSR is Total Debt Service Ratio, and it's pretty similar to GDSR, except it also includes other debt costs. So if you have credit card payments you need to make, or a line of credit, or anything like that, a car payment, that would be included inside of this ratio. So for this one, most people say, hey, you need to have all of your debt be less than 44% of your income in terms of how much you need to pay to keep that debt serviced. But as interest rates start to rise, many people who previously would have qualified under this 39%, under this 49%, well, these percentages are starting to look a little bit higher, and it has some people worried. The effects of these higher interest rates will hit some borrowers sooner than others, and it is determined by whether or not the mortgage is a fixed rate mortgage or a variable rate mortgage. For fixed rate mortgages, people's payments will stay the same even though interest rates are going up, because they won't have to pay that higher interest rate until they renew their mortgage, usually at the end of their 5-year term. But for variable rate mortgages, well, people will have to make higher payments along the way or at a certain point called a trigger point, but we're going to get more into that very soon. And we can see that in 2021, far more people were getting interested in these variable rate mortgages than before. We saw during the first half of 2021, 34% of people opting for these variable rate mortgages. And in the second half, the majority of Canadians, the second half of 2021, the majority of Canadians went with this adjustable or variable rate mortgage at 53% of all people who got new homes or refinanced. So these high rates will affect people with variable rate mortgages more quickly, and people with fixed rates will still be affected by this just at the end of their mortgage term. So the banks and insurers aren't just worried about people with variable rate mortgages, they're also worried about people with fixed rate mortgages, because eventually those interest rates are going to hit them when they have to renew. And this is what is causing people to change the way that they're doing things to make it less likely that these homeowners will stop making the mortgage payments. Now, there are two big things that they've started to do. The first one is something called a reverse amortization, in which when someone's making their mortgage payments, even though they're making their payments along the way, the amount they owe is actually going up over time. This is something that's being applied to very specific mortgages called variable rate mortgages with fixed payments, and they're the only type of mortgage that have this trigger point function. Let me explain. With these variable rate fixed payment mortgages, even though your interest rate is changing over time as the Bank of Canada changes what the prevailing interest rate is, well, your payments will stay the same. It's just the portion of your payment that goes to paying interest will increase when rates go up, and the portion of it that is paying off the mortgage itself will go down as interest rates go up, right? More of your payment, your fixed payment, is going towards the interest instead of the house. That is until you reach a trigger point where you reach the point that your entire mortgage payment is only going to interest instead of paying down the home. This is a big problem. Now, this is from TD Bank's website, but there are reports that are saying that CIBC is doing this as well, saying that even once you hit the trigger rate of your adjustable rate fixed payment mortgage, your unpaid interest will start to increase the amount that you owe on your loan. And then they say at some certain point that they haven't determined here precisely, you'll be required to adjust your payments, change them so you're actually paying down the mortgage, make a prepayment on your loan to lower the amount that you owe on it, or convert it to a fixed rate mortgage. But again, they're kind of opaque with when this would actually happen and how far past your trigger rate you can actually go. But some mortgages do have a maximum amount for how much you can add to the amount that you owe on your home while you're continuously paying interest-only payments on it. For CMHC loans, this maximum is 105%. So if your loan was for $100,000, you could only do this up until the point where your loan was now worth $105,000. This would be largely for people who have put down less than 20% down payments on their homes, because if you're paying under 20% on your down payment, you have to get mortgage insurance, and that is what CMHC does. It's the quasi-public private crown corporation that insures mortgages, but we'll get more into the insurers in a second because things start to get a little wild. However, for mortgages where people are putting down the 20% down payment, otherwise known as uninsured mortgages, well, there's no hard cap like this. There is a regulator that looks at all the people who are offering these kind of mortgages called OSFI, Office for the Superintendent of the Financial Institutions, but they say that we have not set a specific amortization cap for financial institutions allowing negative amortization, meaning that they could go past this 105%, go to 110%, 115%. We just don't know how far they're going because they don't have to tell us. But the OSFI, the regulator of these big banks, says, however, we do expect actions taken to remain within the bank's risk appetite. So they're saying, well, they won't go too far past 100% because then that gets too risky for the banks who actually gave out those loans, because those loans aren't insured. The issue here, of course, is that homeowners that are in this negative amortization situation just aren't paying down the loan. They're actually getting into more debt, hoping that maybe interest rates will go down lower and housing prices will go up in the future and everything will be solved at some point down the road. But this negative amortization or paying up your mortgage isn't the only special thing that insurers and banks are doing to make sure that people don't default on their mortgage loans. They're also doing something that's allowing folks to stretch out the amount of time that it's going to take them to pay off their loan by up to 15 years. Now, even though Canadian homeowners need to renew their mortgages every 5 years, the amount of time that their mortgage is stretched over is usually around 25 years, meaning that if they were to keep the same payments at the same fixed rate for those 25 years, the entire home would be paid off by the time that last payment gets paid. That's called a 25-year amortization. But all of a sudden, if you start to raise the amount of time that it takes to pay off that home, the average monthly payment starts to go down dramatically. So even though interest rates are going up, if you extend your amortization or the amount of time that you have to pay off your loan, well, payments, even though interest rates are higher, can be lower. So you could stretch it to 30 years instead of 25 or 35 or now even 40. And it's becoming even more common. Take a look at this. A recent Globe and Mail article says that at CIBC, RBC, and BMO, the percentages of mortgages with amortizations of more than 30 years, not just 25, more than 30, recently doubled in a 3-month span, and each bank has reported as of this summer that about a quarter of all of their residential loans are mortgages with terms in excess of 30 years. So for some people who got mortgages in the past few years, or even if they're in a variable rate mortgage right now, it might make sense for the banks to contact them and say, hey, it's looking like your payments have gone up substantially. Maybe we should stretch out that amortization so you can get lower payments and pay down your home more slowly. And that's exactly what certain mortgage insurers are trying to make it easier to do. This is Sagen or Sagen, I'm not sure how you pronounce it, but it was previously known as Genworth. That might be more familiar to you. This is the largest mortgage insurer that is privately owned in Canada. We already talked about CMHC. This company does exactly the same thing that the CMHC does, except it's privately owned, not this quasi-public private crown corporation that the CMHC is. So for people who put down less than 20% and have a mortgage insured by Sagen, they're trying to make this extension of amortization periods even easier because it provides immediate relief to homeowners by reducing the mortgage payments and improving overall affordability. Now here's something that you might not know about mortgage insurers. They're actually heavily incentivized to not want people to stop making their mortgage payments, because when your mortgage is insured, that's not actually an insurance that is for you, the homeowner, even though you're the one paying it most of the time. That insurance is actually for the person who is lending you the money. If you were to stop paying your mortgage and the bank ended up eventually with ownership of your home and they sold it at a lower price than what the loan rate was for in a market that's down like this, that's not entirely unheard of, well, then the amount of difference that they sort of lost on that loan would be covered by this mortgage insurance provider. So the mortgage insurance providers are like, hey, we do not want that to happen, because otherwise we might have to start making more insurance payouts to these big banks who are offering these mortgages. And what do insurance providers like less than actually paying out money, right? Now they're saying they're not going to offer this to absolutely everyone. One of the main criteria is that the homeowner has to actually show that they are in financial distress of some kind. And the way that they're doing that is saying, hey, if your GDSR, remember we talked about that, gross debt service ratio, if that is over 39%, or it will be at the time that a renewal will happen, well, then you can contact these people and say, hey, do you want to extend this out? And they provide a couple of examples inside of this document that I think are actually pretty helpful. If you were someone who had a $500,000 mortgage back in January 2020 at a 2% 5-year variable rate, well, your original monthly payment would have been $2,119. But if you were to refresh that mortgage, renew that mortgage, refinance that now, that very same mortgage at this point in time, your new payments would be up significantly to $3,024, or an increase of $905 per month. If the rise in that payment resulted in your gross debt service ratio, that ratio between the amount of income you make versus the amount you have to pay on your home, if that was over 39%, well, they could offer to extend the amount of time it takes to pay your mortgage up to 40 years to bring you back down to that 39% point, reducing payments significantly. That would look like down from a $3,000 payment down to $2,400. It just goes to show how, especially in a market that is down, like one we're currently in right now, just how far banks and insurers will go to make sure you keep paying your mortgage payments, because the last thing they want to do is foreclose or go into power of sale, because that is a total headache for them to take on. And in many senses, it would be far less profitable than if they were just to work with you so that you could keep on making your payments and they could keep on collecting them. But the extent of the consequences of these changes really depends on what the Bank of Canada does moving forward. And if they continue on their rapid interest rate increasing cycle that they seem to have been on, there are signs that it's sort of starting to slow, but we don't know for sure how much farther they're going to go here. Mortgage experts like Robert McLister are saying that, hey, if the Bank of Canada doesn't raise it by another full percentage point here and instead do it about 50 or 75, or a 0.5% or 0.75% interest rate increase, then he says we'll get out of the woods relatively unscathed. And that's especially true if rates revert to lower percentages before the end of next year. But if the bank hikes this up past 5%, we could have an unexpected arrears problem. In that case, you wouldn't be shocked to see the government announce some type of measure to help out distressed borrowers who can't afford their new payments. And he calculates that if rates go higher, we could see almost 1 million households hitting their trigger rate, but he says that only roughly 250,000, or a quarter of those, will experience this reverse amortization that we've been talking about in today's video. And he calms the worry, saying that, and of those, only a single-digit percentage would eventually end up defaulting if we were looking back at history and the average rates we've seen in the past. So it's not all doom and gloom, and it doesn't look like many people will actually reach this most extreme point, but it is interesting to watch how these lenders and the people who are insuring these loans are starting to make concessions to say, hey, just keep paying your mortgage because we would like to keep on collecting that instead of dealing with all the fallout if you stop. Now, obviously, that was a lot to digest, and if you've made it this far in the video, I'm curious what you think about all of this. Let me know down in the comments below. Do you think the Bank of Canada is going to keep going too far and potentially break things in the mortgage industry, or do you think that maybe we could have some sort of soft landing here? Either way, let me know down in the comments, and subscribe to the channel if you haven't already done so yet. I constantly am bringing these Canadian-focused updates, and I think there's not quite enough of that happening on the YouTube platform, and a subscribe is free, and it helps out the channel dramatically, so I'd appreciate that. But with all of that said, thanks so much for watching, everyone. I really hope this video has helped you out at least a little bit, and I'll see you next time.